Guys, welcome back to probably one of the most disliked topics in the whole of CeMAP 1. So sit tight, we are going to get through this together, and I promise this is not going to be as bad as the textbook makes it seem. So we are going to be focusing on topic 6 of your CeMAP 1 textbook, which is called cash and fixed interest securities. Or it's not, it's called direct investments, cash and fixed interest securities. And there's quite a few different things that we have to get through. The first thing that I want to talk to you about is the word asset. Now, you've probably heard of the word asset before, but what you might not realize is what an asset actually is. And this is so important for all of CeMAP, whether it's CeMAP 1, 2, or 3. So ultimately, an asset is something that you can either own or control that has a monetary value and it has the potential to make you money. So it could be something as simple as cash in the bank, because if you've got a savings account and it's got an interest rate return on it, that is making you money. It could be a buy-to-let property. You rent it out, you make money on the house when you sell it, and somebody's paying the mortgage off for you. It could be an investment. We don't really talk about crypto or Bitcoin at all in CeMAP because it's not regulated, but that's another type of asset. Anything that has a monetary value and can make you money is classed as an asset. Property, equipment, think about how expensive something like Jeremy Clarkson's Lamborghini tractor would be if you are a Clarkson's Farm fan. So that's an asset. That is very similar to the word capital. And actually what you find is people interchange the word assets and capital all of the time. There's nothing wrong with doing that. But usually when we refer to something like an asset, we say, okay, this has a monetary value. I could swap it in for cash and have cash in my hand right now. Capital is similar in a sense of it is something that has a monetary value, but we generally only use the word capital when we are talking about buying more assets with that capital. For example, when you take out a mortgage on a residential or a buy-to-let property, they will say, what is your initial capital investment? Or, hey, how much of a deposit do you have? That is the money that you are going to use to get your asset. The asset being the residential property that you're going to buy or the buy-to-let property that you're going to buy. So whereas the house would be the asset, the deposit that you put into the house would be your capital. That is the best example that I can give you. And that's what we're going to be talking about for the rest of this topic is different types of investments, assets, capital, all of that good stuff. So guys, I would like you to write these down. There are 4 main financial asset classes that we talk about in CeMAP. Number 1 is property. Now this can be your own residential property. They're classed as an asset or an investment because they tend to go up in value. Also buy-to-let properties are an investment venture. Number 2 is cash. So cash in your bank account. Be careful with CeMAP, guys, because in your exam, they won't use the word current account or savings account. They very rarely use that word. Instead, what they will use is deposit account. And people look at the word deposit account and they go, I can't remember what that means. I can't remember what that is. It's just another word for a bank account or a savings account. So please be mindful of that. You won't see bank account, current account, savings account in your exam. Usually they will use the word deposit account. And then the bottom 2 are the 2 that we might never have come across before. One is called a fixed interest security. And the 2 types of fixed interest securities that we talk about in CeMAP are gilts and corporate bonds. And the other one is equities. Guys, an equity is just another word for a share in a company or a direct investment in a company. But we are going to do loads on that over the next few topics. Make sure you've got these written down. So, as I mentioned, your textbook will use the word deposit-based investments, and ultimately that just translates to us as a savings account or a cash in your current account with a bank or a building society. One thing that people very often forget to recognise in their CeMAP 1 exam specifically is how inflation generally tends to impact current accounts or savings accounts. So I want you to think about your bank account right now. You might have a current account that all your direct debits go out of and that your wage comes into. You might also have a savings account attached to it, which you'll just put an emergency fund or a house deposit fund or whatever goes into that other bank account. If that other bank account doesn't have an interest rate return attached to it that is higher than the current inflation rate, your money is technically going down in value. So, for example, if you had £10,000 in a bank account last year, back in 2024, the inflation rate at the end of 2024 sat around 13%. So if you didn't have a 13% return rate on that bank account, from the start of 2024 to the end of it, if you didn't make 13%, your spending power of that £10,000 was less. Most people's savings accounts did not, in fact, give them a 13% return last year, which means that that money went down in value. And that's something that can crop up in people's CeMAP 1 exams, because one of the things that people generally don't connect is the inflation impact on your cash. Because if inflation goes up, the spending power of your cash can potentially go down if it's not going up at least in line with inflation. Hopefully that makes sense. These are our different types of deposit-based investments. Ignore gilts, that bottom one, we're going to come on to that separately in a second. But we have traditional current accounts, which is the one most of us will have. You generally get your wages paid into it. Your direct debits come out of it. Everyone will probably have one of these. That is slightly different to a basic account. Now, a basic account is something that's generally offered to people who don't have an income. And you might not realise this, but if you don't have an income in the UK, most bank accounts won't accept you because they want to see money coming into it. If you're unemployed and you don't receive universal credit, or you don't have a fixed income and you can't meet the minimum requirements, it is a blocker to opening a bank account. And that's problematic because if you don't have a bank account, you can't get a job because there's no bank account to pay you in. And if you can't get a bank account and a job, that means you can't get a house. And if you can't get a house, you've got nowhere to live, you can't get a job, you can't get a bank account. It is this vicious cycle that goes on and on. That is where basic accounts come in. They are more basic banking facilities that anybody can open, generally, even if they don't have a regular income. Interest-bearing current accounts is just a current account that might offer you a particular interest rate return. Those are generally offered to higher earners who get a minimum amount paid into the account every month. The return isn't massive. It might be 1 to 3%, which also happens to be the average inflation rate percentage, but they do exist. Packaged current accounts we used to see a lot of. You have seen these advertised before probably, where it will say, if you open up a bank account with us, we will give you travel insurance included, or mobile phone insurance included, or any particular perks. We don't see these as much anymore because there's actually a big claim back scheme. So if you ever had one of those accounts, you can claim compensation for the mis-selling of it, which is why we don't see these as often. But they do still exist. And then that's current accounts boxed off. With savings accounts, these are all pretty straightforward. So instant access savings accounts is the one that we probably all have. They're in our banking app, they're connected to our current account. We can swap money backwards and forwards if we need to. They generally don't offer an interest rate return, or if they do, they're not super high. You can also get restricted access accounts and structured deposit accounts, and these are the ones that tend to offer a slightly higher interest rate return because your money can be tied away and then sometimes even invested in certain places with a little bit of that money. So that's the difference between those two. National savings and investment products, I'm not going to touch on too much in this topic, and that's because we cover it in way more detail in a different topic. So we're just going to brush past it for now. Offshore accounts I'll come on to in a second, as with gilts. And I missed ISAs or individual savings accounts. We have an entire topic to study on ISAs, so we're not going to do that in this topic either. So structured deposit accounts, just to expand on that one a little bit, with these, they tend to be linked to the performance of an index. Now, when I talk about the word index, I'm talking about something like the FTSE 100 or the FTSE 250, the FTSE All-Share Index. You may have no idea what that is, and that's absolutely fine. You're exactly where you need to be. With these types of indexes, it is basically where people can go to have a look at the top performing companies all across the world. So, for example, if you're an investor and you wanted to buy shares in a particular company, what you would do is you would look at the FTSE 100 or the FTSE 250 and go, which companies are doing really well? Which company do I think I can make money on? Most of you will have laptop updates on whatever you're studying this material on, and in the bottom left-hand corner, it might give you the FTSE index updates, and it'll say something like FTSE 250 plus 4.81% or minus 2.3%. That is the index that we're looking at. It is effectively like the stock exchange. National savings and investment products, I'll do a little bit more actually on this now, just to make sure we've got a really good understanding of what they are. National savings and investment products are investment products that are backed by government. So effectively, it's a government website that you can go on and you can buy particular investment products. The reason that they are different is because they are backed by government, they are considered super, super safe investments, because we don't anticipate the government dropping any big balls or going bankrupt or anything like that. In terms of your CeMAP exam, what is likely to come up under national savings and investment products is to do with their tax status. So I will do this in a little bit more detail, but just to touch on it now, NS&I products are not tax-free. You absolutely pay tax on national savings and investment products. Dependent on the type of investment will dictate what type of tax you pay. But point number one to write down is they are not tax-free unless, and this is point number two, there is something called an NS&I premium bond. It's the most popular type of NS&I product. The way that they work is it's effectively like a savings account, and for every £1 that you put into that savings account, you get entered into a lottery. The lottery happens every week, and you can win, I think, anywhere between like £10,000 and £50,000. Every week you can get entered into that. The more money you have in that savings account, the more chances you have of winning, and the more money gets paid into that pot. The key difference between any other type of NS&I product, which is taxable, is that the winnings that you can make on premium bonds are not taxable because they're classed as lottery winnings and they are tax exempt. So just to recap, to make sure you've got this in your notes, NS&I products are taxable. The exception are winnings from NS&I premium bonds. They are tax-free because they are classed as lottery winnings. Offshore accounts. Now, offshore accounts you may or may not have heard of before. These tend to be really useful for people who might have property outside of the UK. So I don't know if you've ever been on holiday and you try and change your money and it all seems more difficult than it should be because of the exchange rates. If you're a UK resident with a property in Spain, it makes sense to have a Spanish bank account because if you use your British bank account abroad, it tends to come with higher charges. The other advantage with an offshore account is that if exchange rates are working in your favour, you can sometimes financially benefit from that. We used to talk about how offshore accounts can help mitigate your tax liability, but because we have reciprocal tax treaties with a lot of other countries now, we don't actually see that as much. Unless you're a resident of a different country, you might be able to mitigate the tax stuff there. But generally speaking, the main benefit is if there's an interest rate working in your advantage, you might make a little bit of money. Guys, stick a line under that, pop your pen down for a second and take a really big breath. I'm not going to ask you to make notes for just a minute. We are going to talk about gilts. Gilt is the single biggest thing that can come up in the first half of your CeMAP 1 exam. So the first half of your CeMAP 1 exam is 50 multiple choice questions. You can potentially get up to 7 questions on gilts. So we are going to take this really, really slow. I'm going to over-explain everything. I'm going to make sure you've got time to write notes. Don't forget you can hit pause if you're not keeping up too good. And there's also extra downloadable material and an extra training session on gilts. Please make sure you feel super comfortable with all of this before you move on to the next topic, because I would argue this is the single biggest topic that comes up in Unit 1, and it will be the difference between a pass and a fail. So with that in mind, your next subheading is gilts. Now, gilt stands for gilt-edged security, and you can see this picture up on the top right-hand side of your screen. That is what a gilt looks like. And the reason that it's called gilt-edged, guys, is because these are edged in gold. Gilt just means gold covered. The first reference we have seen of guilt dates back to, I think it was a Jane Austen novel, and she talks about how her potential male suitor is a very attractive option because he has a pocket full of guilt. Basically, he had loads of money. So a gilt is where you are going to lend money to the government. They will give you this piece of paper in exchange. I don't think you get those anymore. I think they're pretty outdated now. But you are going to lend money to the government for an agreed period of time in exchange for a regular payment. And that regular payment is called a coupon. So let's put you in the picture with a gilt. And I want you all to imagine that you have £100,000 kicking around doing absolutely nothing and you don't know what to do with it. Now, there's a couple of reasons that we probably wouldn't recommend a gilt, which I'll come on to. But what you could decide to do is go, okay, I'm going to go onto the gilt website. I'm going to give the government £100,000 for 5, 10, 15 years, you can choose. And then every 6 months, they will give me something called a coupon, which is basically an interest payment on the money that you've lent them. When you get to the end of your 5, 10 or 15-year term, you will get your £100,000 back. That's how a gilt works. Now, because it's really safe to assume, or fairly safe to assume, that the government won't go bankrupt, gilts are considered the most safe investment. They are super safe. They are considered even more safe than putting money in your bank account. And what do we know about safe investments? The lower the risk, the lower the reward. Now, an update from the 2024-2025 textbook talks about something called a green gilt. A green gilt is just a different type of government investing product, but your money is going to go to greener or more eco-friendly, or however you want to phrase it, incentives. So the only difference between a gilt and a green gilt is with green gilts, if that's where you invest your money, they guarantee that that money will go towards more environmentally friendly incentives. If it's a normal gilt, it doesn't. But what I want you to remember is that because they are considered super low risk, they also come with a fairly low reward because they are the safest type of investment ever. Everyone will get this question in their CeMAP 1 exam, so make sure you've got all this from this slide down. Gilts are categorised by the length of time they run. So how long you decide to lend your money to the government. The other way that they can phrase this in your exam is they are categorised by their duration. And that just means the length of time that they have to run. And you do need to know the difference between these two green boxes here. So to start with, we have the UK Debt Management Office on the left. They are a government department. They are the guys that issue gilts. So what that means is they put them up on the website to sell them. They categorise gilts in two different ways. It will either be a short-dated gilt, which means it will run anywhere between 0 and 7 years, and at the end of that term you get your money back. Or it will be a medium-dated gilt. And if it's medium-dated, it means it will run between 7 and 15 years. That is the Debt Management Office's categorisation rules. The financial press are not the guys that issue the gilts. They are the guys that report on the gilts. So the financial press, in my head, because I'm a very visual learner, I have to think about the physical newspaper that people read to read about investments. Obviously, we now have the internet, and I'm sure they have a website, but I need to imagine the physical newspaper. Now, for some reason that I can't explain, the financial press decided that when they advertised these gilts, they were going to categorise them slightly differently. So whereas for the Debt Management Office, you have short-dated and medium-dated, for the financial press, you have short-dated, medium-dated, and long-dated, which can be kind of tricky to get your head around. But please write these down. So with the financial press, their short-dated gilts have less than 5 years to run. Their medium-dated gilts have between 5 and 15 years to run, and long-dated gilts are 15 years plus. You do need to know the difference between the two. They can come up in your exam, so please make sure you have made a note of both of these boxes. And gilts and their tax status. So as a thank you for lending the government that money, they are going to pay you something called a coupon rate. and that is just an interest rate every 6 months. So it's an interest payment. It is paid directly into your bank account. You do have to pay tax on that. It is classed as savings income, and it's taxed at whatever your tax banding is. So it'll be 20%, 40%, or 45% tax. Couple of things to write down here on top of this slide, guys. Number one is that it is called a coupon payment. That's the interest payment you get paid every 6 months. That's point number one. Point number two is that they are paid without the deduction of tax. So that means that you would have to declare that income through self-assessment and pay your tax accordingly. And point number three is that it is taxable, and it's taxed as savings income. They could be 3 potential exam questions, guys, so please make sure you've got all of those sentences written down. Now, underneath, it says, remember that gilts are exempt from capital gains tax. So if you sell it for a profit, no tax is payable. And actually, I want to talk to you about that in a little bit more detail. So I'm going to stop sharing for a second. So you could potentially buy a £100,000 gilt for 10 years. Every 6 months over that 10-year period, you will get your coupon rate. You will declare that. You will pay tax on it. And at the end of the 10 years, you get your £100,000 back. Happy days. You can actually sell your gilt. So if you imagine that 5 years into your 10-year gilt, you decide you actually want that money, there is a marketplace for second-hand gilts, and somebody else will effectively buy you out of that investment. You can potentially make money on this because if the gilt that you bought 5 years ago had a 5% interest rate return or coupon rate return, and right now brand new gilts that run for 5 years only have a 2% rate, somebody or an investor is going to be much more attracted to your gilt than the new gilt. So they might decide to buy you out of that gilt. Because they know that they are going to get a better return rate, you can actually charge over the odds for that gilt at the time if the market is really strong. So for that reason, you can potentially make money when you sell it. When you make money, or if you make money selling your gilt, you do not have to pay capital gains tax. And that's a massive advantage for investors. That's one of the main reasons big institutions invest in gilts, is because there are not many tax advantages to any investment. Gilts is probably one of the only ones. So make sure that you have written down from this slide, guys, this bottom bit here. Remember, gilts are exempt from capital gains tax. So if you sell it for a profit, no tax is payable. And as we finish up with gilts, there is something called index linking. And what that means is you can buy a gilt that is index linked. It just means that the interest rate return you get is based on inflation. So it means that your investment should go up in line with inflation, or at least the coupon rate should. And that is a massive advantage. A lot of people prefer index-linked gilts for exactly that reason. Okay, line under gilts, guys. Please make sure you have everything that you need from that small section because it is so heavily weighted in your CeMAP 1 exam. The next thing that we're going to talk about is something called a local authority bond. And the easiest way to remember this is that a local authority bond is exactly the same as a gilt, except it is not offered by government, it is offered by your local authority. So local authority bonds are considered to be the second most super safe investment because it's not expected that your local authority will go bankrupt. I appreciate that you might have heard that Birmingham County Council did go bankrupt last year, but for the purposes of CeMAP, that never happened. We're going to completely forget about that. And we are going to go, okay, look, gilts are the most safe investment, followed by local authority bonds. Other bits to write down with this is that they are secured on local authority assets and they offer a guaranteed rate of return, which is paid every 6 months. Whilst they are safe, they are not as secure as gilts because there is no government guarantee with them. It is just a local authority guarantee. We also have something called PIBS, and I am going to give you a hack for this. So it is called a permanent interest bearing share. Your textbook shortens it to PIBS, P-I-B-S. The hack for this is I want you to take the BS and remove bearing shares from your brain. Instead, you're going to replace it with building society. PIBS, Permanent Interest Building Society. I realise that makes no sense, but the only thing that you need to know about a PIBS is that it is the same premise of you lending a building society money in exchange for a return rate. That's it. So you're going to think permanent interest bearing shares. No, actually, PI building society. That's how you will remember who they relate to. But outside of that, they work exactly the same as gilts and as local authority bonds. You lend them the building society money. They are going to give you a return rate every 6 months as a thank you. Corporate bonds. Guys, again, this is the same principle. You are going to lend a company money in exchange for a return rate. Corporate bonds are considered the highest risk of these, and that is because whilst we generally don't see governments going bankrupt, we do see companies going bankrupt all the time. So they are much higher risk. What does it mean if it's higher risk? Generally, it means there's a higher return. So investors like this option because they can make a lot of money from it. That being said, they can also potentially lose a lot of money from it. There is something called a debenture. So this first sentence on the slide here, a corporate bond that is secured or attached to the company assets is known as a debenture. That is a very common CeMAP question. Please make sure you have that written down in your notes. And as I mentioned, because companies go bust all the time, they are much riskier than gilts. They're not backed by government. They're riskier than local authority bonds. They're riskier than permanent interest-bearing shares or the building society equivalent. Because they are high risk, they could be considered higher return. And we have Eurobonds. Eurobonds are a form of borrowing generally only used by either multinational organisations or governments. So as a private investor, you probably wouldn't look at Eurobonds. They are also much riskier, and that's because they operate outside of the jurisdiction of your actual currency. So you would be investing your UK money in euros or a different currency, and you have the added risk of exchange rate fluctuation with that. As long as you have this written down for Eurobonds, guys, that's everything that you need. And as we come towards the end of this topic, we have something called peer-to-peer lending. This is probably the riskiest of the ones that we've gone through. It involves you placing your money with a company that's called a peer-to-peer lending company, and they are going to lend that money out to high-risk businesses. So the peer-to-peer lending company are going to take your money, they're going to lend that money out to businesses that are seeking funding. In some cases, returns can be very competitive, but there is much more risk involved. And with that in mind, there is no financial services compensation scheme protection with this one. They are super risky, so please be aware of that. And finally, the tax status for these guys. So local authority bonds, corporate bonds, permanent interest-bearing shares, and Eurobonds pay interest gross. And what that means is they pay it without deducting the tax. That means that you have to declare the income and you have to pay the relevant tax on it. If you are over your tax-free allowance, you will pay tax on it. And guys, that is everything that we need to know for topic 6 of your CeMAP 1 studies. So I hope that's been really helpful. Please make sure you go through all the extra material underneath this in the e-learning platform. So you have the exam prep questions, you have an audio file, you have an ebook, and you probably have some extra PDF downloads. Please do all of those for this topic because it is so heavily weighted in your exam. And as always, feel free to message me if you have any questions.